I'm old enough to remember when $1 trillion in a year for ETFs was an absurd prediction.
All right, joining me will be Brian Walsh, head of advice and planning at SoFi, who currently offers 5 ETFs, nearly $800 million in assets, including an ETF that just launched last week, the SoFi Social 50 Income ETF, ticker SFYI. This is an options-based strategy, and we'll certainly get into all the details of that ETF. But we're also going to spend some time just looking at broader ETF and investment trends across the SoFi platform, because SoFi has nearly 15 million members that use what the firm calls the everything app for digital financial services. So that includes investing, borrowing. They offer banking, crypto trading. They really do it all. And so that puts SoFi in a unique position to be able to observe key trends from across all of those areas. And we're going to focus specifically on some of the broader ETF and investment trends, basically where SoFi members are putting their money right now. So we'll do that. And then I also want to spend a few minutes discussing SoFi's approach to the ETF market overall. Should be a great conversation. Now, to start this week, I'll be joined by the one and only Todd Rosenbluth, head of research at VettaFi. And as we typically like to do, we're just going to jump around on several different ETF topics, including a few of Todd's big ETF takeaways from the first half of the year. We'll also find out a couple of items that Todd is watching for the remainder of the year. Let's see. I also want to ask Todd about State Street and iShares recently entering the Nasdaq-100 ETF category, which is bringing some real competition to Invesco's QQQ and QQQM. And then we will spotlight another brand new ETF, the Defiance KSM TipRanks Analyst ETF, ticker RANK, great ticker. This takes a unique approach to helping investors balance fundamental and technical analysis. And VettaFi is involved with the index behind that ETF. So I'll let Todd spotlight that. And then I am hoping to work in at least a little crypto to close our conversation just to irritate Todd. So I want to ask him about a new active crypto ETF that's on the way. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now welcome in VettaFi's Todd Rosenbluth, who is joining me from New York. Todd, is the worst part about coming on here that I make you talk crypto ETFs?
There's no worst part about this. I love talking ETFs, and I love talking ETFs with you. So thanks for having me here again.
Well, I like that, and I'll do this. Let's put off the crypto topic for later. I won't hit you with that right up front. So look, your colleague Kirsten Chang and I, we recapped the first half of the year in ETFs a couple of weeks ago on here, and so I'm not going to have you rehash everything we covered. However, I do always appreciate hearing your big picture industry takes. And since we haven't chatted in a little while, I thought I'd start by giving you an opportunity to highlight maybe 2 or 3 of your biggest takeaways from ETF so far this year. So I'm just going to give you the floor here. What are a couple of things standing out to you?
Do you want me to do one and then you respond and then a second one? Because I'd like to have your take on things quickly too. Does that work?
However you would like to do it.
All right, then I'm going to pause after the first one. But Nate, you don't seem it, but I'm old enough to remember when $1 trillion in a year for ETFs was an absurd prediction. You might remember, some listeners might remember 2020 when a new record was set with $500 billion of net inflows. So the fact that we hit $1 trillion before anybody went on summer vacation, that's just bonkers to me. And the fact that we all just think that's normal, or I don't think that's normal, and I don't know if you think that's normal, but that's just the ground level for people is just hard to believe. It's amazing how ETFs have become the default vehicle for retail investors. ETFs are now part of the federal government's plan for retirement for young children. The Trump accounts has SPYM, that's a State Street S&P 500 ETF. That is the default vehicle. So the fact that ETFs have become so mainstream that $1 trillion is now the baseline, that is definitely my ETF story of the year.
Well, as Meb Faber said on here last week, ETFs are eating the investment world. And he said that for a while. But uh, to your point, I mean, ETFs are everywhere now. And I was looking at flows this morning. If you look over the trailing 1 year, we're over $2 trillion in inflows. We're currently sitting at about 1.1 trillion for 2026. And I've talked a lot about this. I don't think this is anything overly enlightening, but it's been a good year, clearly, in the markets overall. But we had some volatility in the first quarter, and then recovered in the second quarter. And I think the market no longer matters as much to ETF flows. I think whatever happens in the markets, there's going to be a tool that investors can lean on in the ETF space. And I bring that up just because I used to be the one, and even fairly recently, saying ETF flows are market dependent. I'm not sure that's the case anymore. I think even if we get a significant drawdown, say in the second half of the year, we're still going to see ETF flows hang in there, inflows hang in there, because investors will just pivot over, say, to fixed income or alternatives or whatever the case may be. So I agree with you. If you're looking back on what's happened so far this year, that 1 trillion in inflows in the first half is probably the headline there. But it is amazing for both you and I, who have covered the space for so long.
Okay, you're going to acknowledge how old you are too in this scenario. So my second story, or second thing that just is reflective of is the supply. So when you have demand, it's logical that you're going to have supply. I believe 728 new ETFs launched in the first half of the year. We had less than 1,200 for all of 2025. We had more than 200 ETFs that launched in the month of June. Our friend Ben Johnson refers to ETF launches as a spaghetti cannon being fired. And I think that is appropriate in certain categories, certainly in the leveraged ETF space. We now have leveraged ETFs, and many of them tied to stocks I don't even know existed, but there's now a leveraged ETF or two or three that are connected to it. And I think it's logical to ask, are there too many ETFs and can these succeed? And so I like to look back at what has worked. So there were a few ETFs that hit their 3-year anniversary in June, and they're definitely success stories. So thanks to financial advisors, we saw the Victory Shares free cash flow ETF, VFlow, hit $8 billion before it hit its 3-year anniversary. That fund now has a Morningstar rating. It's a 5-star fund, but it clearly didn't need it before investors adopted it. The T. Rowe Price Capital Appreciation Equity ETF, TCAF, hit $7 billion before it hit its 3-year anniversary in June. So we certainly can find there's new products, or relatively new products, that have come to market. I know you've talked about some of the success stories of this year in other episodes. So DRAM and NASA and that ProShares money market fund, those are all billion-dollar products, less than 6 months old. So more supply, but there is still demand for even that new supply.
Yeah, and I think if I had to summarize what you just said there, and I love how you framed that. First of all, as we sit here today, again, I was checking this morning, there's been over 800 new ETFs launched in 2026. It's just wild. And so ETF innovation clearly is alive and well. But to your point on some of those big success stories like VFlow, what I always have confidence in is that the market is going to decide who the winners are. And so I think it's great that we have this innovation. We have issuers trying to bring all sorts of products to market, but ultimately it's going to be investors who decide which ones are successful. And, that's the beauty. We always say ETFs are a meritocracy. And again, you pointed out a couple of success stories there. So that would be my takeaway. Let me ask you this. What about if we look to the remainder of the year? I know there's a lot we could discuss in the ETF world, but again, if you had to pinpoint maybe 2 or 3 items that are most on your radar as we look to the back half here, what would stand out to you?
So my easy answer is, what month are we going to break the record for net inflows for a year? Is it going? So I'm a baseball fan. Is it going to be before the baseball playoffs start at the end of September? Is it going to be before the World Series at the end of October? We're definitely crossing 1.5 trillion. As you mentioned, we're on pace for $2 trillion. In fact, 12 months, we've seen that. My slightly more provocative, if I can, take for the second half of the year is, when are we going to have record inflows for fixed income ETFs? So I remember my friend Nate Geraci, he said one of the ETF predictions for 2026 was going to be that the year of fixed income was going to happen. And he's been right, because we're on pace again to set a new record. Last year, we blew away the record for fixed income ETFs, and we're on pace again. So let me just turn to my notes for a second. We've got $340 billion, according to the data that we source from FactSet, that have gone into fixed income ETFs. That is easily going to set a record. Advisors are increasingly turning to fixed income ETFs for their ease of use, for their liquidity, and to be precise in their exposure. And I think that trend is only going to continue. As you mentioned, if we do get a pullback in the equity markets, fixed income products are going to be the go-to vehicle. They're already popular, and the market's been climbing higher.
Todd, I love when you come on here and victory lap my predictions on my behalf. One of my favorite things. But you're right. I did say this would be the year of fixed income ETFs, and a lot of that was just based on the fact that I thought there was still a lot of uncertainty around where rates were heading, and I think that's clearly still the case. And so I thought investors and advisors would be looking across their tool set in the fixed income ETF category and utilizing it. It's really that simple. I mean, there's some easy ones you can point to. If you look at the top 10 ETF inflows overall, you have two behemoth bond ETFs in that top 10. You have the iShares 0 to 3 month Treasury bond ETF, SGov. You also have the Vanguard Total Bond Market ETF, BND. And as you go further down the leaderboard, you can just see, again, fixed income ETFs all over that. So obviously, I like that you brought that up. And I think you're right. We're going to continue to see that as we move throughout the rest of the year.
So, Nate, then you're going to like my second one, too, because it also ties into one of your predictions. So you had predicted that smart beta would become relevant again. I'm paraphrasing here. Well, this quarter, TMX VettaFi is expected to close on our acquisition of the RAFI indices business. People probably are familiar with the VettaFi index-based products like AMLP and ROBO. Those are thematic-oriented products. The RAFI suite of products are more fundamentally focused. They're core strategies. When we close on this acquisition in the third quarter, it's going to triple the index-based business that TMX VettaFi has to over $260 billion. There are some success stories, or long-time success stories, that RAFI is tied to from a fundamental basis. So the Schwab Fundamental U.S. Large Company Index ETF, FNDX, is widely held. The Invesco RAFI 1000 ETF, PRF, is another several billion-dollar ETF product. Both of these have significantly outperformed the S&P 500 because of their fundamental-based approach to investing that rebalances and is not tied to just a market cap weighted approach. So we at VettaFi are super excited to be bringing these high-quality talent and high-quality indices part of our business. And I think that's going to set up smart beta to have an even greater year as we work together.
Did you know this actually checks two boxes on my 2026 ETF predictions? Because one was the rise of smart beta, or the comeback of smart beta. The other one was an uptick in mergers and acquisitions across the ETF space. And maybe this isn't directly an ETF issuer, but obviously very heavily tied into the ETF space. First, congratulations, or maybe the champagne will be popped in the third quarter, but I don't think people realize how big of an index provider VettaFi has become. Even setting aside this forthcoming RAFI acquisition, VettaFi has become a monster in the indexing world. And I think that's a story in and of itself. And certainly as you fold in the RAFI fundamental indexes and everything that they bring to the table, that's only going to increase the profile there. The other thing that I would say is, and you were alluding to this, we spend a lot of time on here and elsewhere talking about the rise of actively managed ETFs. And that's a very real trend. I think that's going to continue. But index-based ETFs are still core to the industry. whether we're talking plain vanilla indexes or we're talking factor-based indexes or whatever. And I don't think that's going away. And that was, part of my prediction is that ultimately, if you can have, say, fundamental weighted indices where you get what I'm going to call those active tilts, but you do it without the human bias and emotions involved in traditional active management, obviously that can be very attractive to investors. And so that's a good one. Let me do this before we move on, because I do want to ask you about the Nasdaq-100 ETF competitions. So I was thinking about what I'm most watching the remainder of the year. And if I had to boil it down, there were two things that stood out to me. I want to see if either of these surprise you. So the first one was the SEC's public comment request for novel ETFs. And I think that's very clearly tied to the fate of prediction market ETFs, which are just interesting to me. And I think the SEC reviewing their approval process could have some real industry impact. And so I think that's a really big story to follow the remainder of the year. And another one that I'll throw out to you is Corgi and their continued ETF entrance, which I don't know if you saw this. They're already the sixth largest issuer based on number of ETFs. And most of those have come over the past 2 months or so. I mean, think about that, Todd. Sixth largest issuer by number of ETFs. And I get that doesn't necessarily translate to assets. We know that. But I think that's a really unique story that's only going to get bigger. So I don't know if you have any comments on either of those.
I'll do a quick one on each one if I can. The part tied to the SEC that intrigues me most. So you're right. It certainly could impact prediction market ETFs and set the ground rules for it. But it sounded, according to the reporting that I'd heard or read, I guess, is that it might allow asset managers to file confidentially for new ETFs. And I think that can be impactful because you see somebody launch a ETF or file to launch one ETF, and then others are launching or racing to file the same day or the next day, even before they have a fully baked concept, whether they don't have an index or they don't have a portfolio manager to be able to be tied to it, because there's a race to get to the starting line. And so if that changes in the ETF industry and you can protect a bit of your idea and give yourself a bit of a head start, I think that's exciting to me, or that's exciting and that will impact the industry. The second thing tied to Corgi, and again, Ben Johnson's word is spaghetti cannon. When you file and launch that many products that quickly to see what sticks, that is, I think, the definition. They are just launching a bunch of products, and they're going to see and as you mentioned, let the market decide which ones are relevant. And it's possible that some of the other ones close real fast to make room for the next wave of it. But yeah, they are a key contributor towards what we're seeing in terms of the growing supply of ETFs.
Yeah, one thing I'll mention about Corgi is if you look at the price point that they're coming in at, they're very competitive, and in some cases close to the lowest cost or the lowest cost in particular category. So yes, they're firing that spaghetti cannon, and we'll see what sticks, but it's not like they're coming in higher fee and hoping something works. I mean, they're definitely competitive there. One other quick point I'll make, going back to what you were saying on the confidential filings for ETF issuers. I think I love that. This has always been, as much as I love the ETF industry, an area where I've had a lot of concerns, and that you'll have these smaller upstart issuers who put their blood, sweat, and tears into a wonderful idea. And if it has any success, or it looks attractive, the bigger issuers can come and jump in and then typically offer it at a lower price point. And so anything that we can do to protect that innovation, especially again from smaller issuers who maybe don't have the resources, I think that's a healthy thing. I think that's good for the industry. So I'm supportive of that. Okay. One story that I know we are both watching the remainder of the year is this new competition in the Nasdaq-100 ETF category. And so, as you know, last week, iShares rolled out their Nasdaq-100 ETF, ticker IQQ. That has an expense ratio of 12 basis points, though there is a fee waiver that takes it to 10 basis points through July of next year, I believe. And then a few weeks ago, State Street launched the Spider Portfolio Nasdaq-100 ETF, ticker QNDX. That's actually at 10 basis points as the longer term fee. What's your expectation here? Like, can these two ETFs put meaningful pressure on Invesco's QQQ and QQQM? And is there anything else you're watching here?
So first off, I think this is incredibly exciting for retail investors. The fact that you can get exposure to that innovative Nasdaq-100 ETF or Nasdaq-100 index, be able to get exposure to that at an even lower price point. So if you're putting new money to work or the first time around, the iShares or the State Street ETFs can be an advantage as long as you are aware that there's other costs that are tied to an ETF, not just the expense ratio. So I think the Invesco suite of products will trade with tighter spreads. QQQM, as you mentioned, is the lower cost version, the more retail oriented version of Invesco's suite of Nasdaq-100 products. And I believe it just crossed $100 billion in assets. So the fact that Invesco offers two very successful Nasdaq-100 based products is just a credit to how they can cater towards a institutional and a retail audience at the same time. The indexes continue to perform well. That's going to make it all the more appealing. You can get exposure to some of those new up and coming companies. The Nasdaq-100 has SpaceX as part of the portfolio. To your question, in terms of what impact it will have on Invesco, I don't think it's going to have any impact on the Qs. So QQQ is a slightly more expensive, but much more liquid, institutionally minded product that Invesco offers. I don't think there'll be a price change there. I do think it's logical that Invesco brings QQQM down to 12 basis points in the next 6 months to just get ahead of that competition that now is happening and might continue to gather money. So they've priced that to be a lower cost alternative. It no longer is the cheapest alternative to get exposure. So I think that's going to be impactful. And then lastly, could these all be successful? Could we see money go into all of these? Yes. We certainly have 4 S&P 500 based products, 2 of them tied to State Street, that have had success over the years. As we were talking about earlier, SPYM was chosen by the US government to be the default vehicle, in part based on its size, not just its fee, but in terms of its liquidity. So I do think there's going to be healthy competition in the ETF industry as a result of this.
I think I agree with all 3 of those takes. I mean, if you look at QQQ, that's clearly the liquidity king. It has that liquidity moat. And so I don't think Invesco is going to feel pressured to lower the fee on that in any capacity. I think with QQQM, I think they will feel a little pressure because they are going to have to compete against State Street and iShares. And we can debate how much of a difference 1 or 2 or 3 basis points makes, but you and I both know that investors and advisors pay attention to that. And we've seen it with SPYM from State Street and their S&P 500 ETF that's had a tremendous amount of success as the lowest cost S&P 500 product on the market. And so I think we will continue to see some, if you want to call it a fee war or fee pressure in that category. Is there room for them all? Again, I agree with you, just because you do look at the S&P 500 space. There are a number of major players there. I think we'll see similar dynamics in the Nasdaq-100 category. But again, another fun story to watch the remainder of the year. All right, we have a few minutes left here. I said we had a grab bag of topics this week. Let's close our conversation by spotlighting a couple of ETFs, including another ETF that actually launched last week that I know you're very excited about. And then I have an ETF that I believe should be launching any day now that maybe you're not so excited about, or at least not quite as excited to talk about. So the ETF that launched last week is the Defiance KSM TipRanks Analyst ETF, ticker RANK. This is index-based, actually an index that VettaFi is involved with. And so I know you're chomping at the bit to talk about this ETF. Do you want to offer a quick snapshot here?
Sure. So you set it up in the beginning. So RANK, R-A-N-K, which is that Defiance TipRanks ETF, combines 2 approaches to analyzing stocks. It uses the TipRanks consensus analyst views for what are high quality, attractive companies, the best companies from a valuation and fundamental standpoint. and then it puts it through momentum and technical analysis. So there's a focus on relative strength. So I'm a former stock analyst. I don't know if you know that. I don't know if listeners know this. I spent the first 10 years of my analytical career doing fundamental research, and I worked side by side with some chartists who would very bluntly tell me why my recommendations were going to fail because the chart was against me. So the fact that we have an ETF that is going to find agreement between the fundamental analyst and the technical analyst and do it in a rules-based, index-based approach that will rebalance on a quarterly basis is exciting to me. And then, of course, there's a back test. And of course, if there's a back test tied to an ETF that's public now, it probably worked. But this did. The index behind the Rank ETF has shown outperformance versus the S&P 500. I recently wrote an article this week comparing it to MTUM, that iShares Momentum ETF, and MOAT, M-O-A-T, which is the VanEck Morningstar high quality MOAT index ETF. And Rank does even better than them when we look backward at the back test. So yeah, I'm excited about this ETF. I think it can solve a problem for people, and it launched during earnings season. So what could be better?
Yeah, and to your point, you sometimes have these raging arguments between fundamental and technical analysts. And guess what? Both can be right. They can both add value. And with this ETF, you don't have to pick, you get them both. And then not only that, like we were talking about with Smart Beta earlier, this is index-based. And so you're removing that human emotion and bias that can come along with traditional active management. So I'll be certainly watching to see what investor interest looks like there. The other ETF I'm going to offer up to you, just to make you talk crypto, is the forthcoming T. Rowe Price Active Crypto ETF, ticker TKNZ tokens. That'll be launching any day now. Into the teeth of a harsh crypto winter, by the way, right? It's summer for us, winter for crypto. And as the name suggests, this ETF does offer active exposure to a basket of crypto assets. How are you feeling about crypto ETFs at the moment?
Well, so I'm a bit surprised that Bitcoin bounced back in the past month, and we've seen outflows. IBIT, I believe, saw $2 billion of net outflows in the past 4 weeks when we saw a bit of a bounce back. So people were holding steady, at least in IBIT, and then they seem to have capitulated as a result. So I think the sentiment for ETFs is weaker than perhaps it is for Bitcoin in general. I think this is an opportunity for T. Rowe Price. They are an active manager that has had a lot of success in the ETF space. They now have $30 billion of assets. They've quickly been climbing that active leaderboard with a fundamental approach to security selection and sorting through the stock market and sorting through the bond market. So it just makes sense that crypto is now an asset class that people are putting within their portfolio, that T. Rowe Price bring their expertise there. So I'm intrigued to see how this fund is positioned when it comes out of the gate. I have to admit, I don't know much about cryptocurrency besides Bitcoin and Ethereum because those are the more popular ETFs. But I believe you're right. This fund can have as much as exposure to 12 or so different cryptocurrencies, which means they can pick and choose. I'm excited for when this comes to market, and it might be at the right timing because sentiment is relatively weak. You can get Bitcoin perhaps at a discounted valuation if you believe it deserves to be higher. What do you think? Are you excited that we'll soon have an active crypto ETF?
Well, a couple of things here. One, I would agree with your take just regarding overall sentiment right now. And while I do think we continue to see what I'll call institutional adoption of crypto ETFs, the fact of the matter is, if you look at Bitcoin ETFs, for example, the average spot Bitcoin ETF holder is way underwater. And so, as you know, just from an education perspective, trying to get people comfortable around Bitcoin or crypto, that's been a challenge all along. And then you add to that now a 50% drawdown in Bitcoin, 60, 70% drawdowns in Solana and Ethereum. I think that has sort of put the brakes a little bit on that institutional adoption. And so I think we'll need the sentiment and the price action to turn around to reaccelerate that. Longer term, though, I'm extremely bullish on both index-based and active crypto ETFs. I think that was actually, again, we kind of have a theme here, one of my 2026 ETF predictions. I think ultimately investors and advisors do want to take a diversified approach to the space, just like they do on equities, just like they do with fixed income. And so ultimately, I expect this to be a very significant category. But yeah, sentiment is poor right now, and we're going to need some positive catalysts. But Todd, we are going to have to leave it there. Excellent stuff as always. Fun chat this week. Thank you for joining me.
It's a pleasure. Clearly, there's no summer vacation for the ETF industry.
Never, which is a good thing, I think. Hopefully we'll get a break at some point. That was Todd Rosenbluth, head of research at VettaFi.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Brian Walsh, head of advice and planning at SoFi, who currently offers 5 ETFs, nearly $800 million in assets, including an ETF that just launched last week, the SoFi Social 50 Income ETF, ticker SFYI. And we will certainly get into all of the details of that and also touch on some of the other SoFi ETFs. But as I noted at the top, SoFi is an interesting platform overall. They have some 15 million members that use them for a full range of financial services. And so if you think about this, that puts them in a unique position to observe various financial trends and really get a good gauge on investor sentiment and all of those sorts of things. And so I'll get into some of that with Brian as well, who is now joining me. Brian, it is great to connect. Welcome to the podcast.
Yeah, thank you so much for having me.
All right. So did I describe SoFi properly there? Is there anything that you would add to my very brief description?
No, I think you did a great job. I mean, SoFi is a digital one-stop shop where our members can bank, borrow, invest, protect their money, all from an app, all from the website, which not only helps benefit our members, but it also gives us, as you pointed out, great insights into what our members are doing, which then allows us to then build products and offer solutions that further solve more of their needs.
And so we are going to get into some of those insights, but I thought let's start with this brand new ETF that launched last week. Again, the SoFi Social 50 Income ETF, ticker SFYI. I guess first, what was the rationale behind bringing this to market? What was the opportunity SoFi saw here?
Yeah, great question. And I think, it goes back to the member insights. So we looked at it, not only our member base, but across the broad market, we see an increased demand for income and looking at alternative source of income beyond the traditional, fixed income playbook or even the dividend paying stock playbook. And we realized that was of utmost interest to our members. At the same time, we see our members also want to invest and experience the growth of high conviction names. So what we did is we kind of combined the best of both worlds, where we said, okay, let's focus on investors that want to generate monthly income, but still want to have exposure to these high conviction names that can provide growth in the future. And that's how we got SFYI. So essentially, we have the income layer that is generated by selling options against the underlying names inside of the investment portfolio. And then the underlying holdings are actually based on our actual members. So we look at all of the self-directed members on our Invest platform. We find the highest conviction names, the highest 50 US equity securities, and that's what the holdings are. And then we use options to generate the income.
And talk a little bit more about that option strategy and just what's going on underneath the hood here.
Yeah, it's actually, pretty similar to one of our other ETFs, Theta, THTA, where Theta actually uses, treasuries as the collateral, whereas SFYI uses these holdings as the collateral. And then essentially what we look to do is sell calls that are really focused on a volatility play, where we're aiming to say, okay, we want to generate income as long as the outcomes are within a pretty wide range. Where, okay, if it goes in black swan type of events, then that's going to be outside that range. And that's what we're looking to do. And then with this ETF, that's a little bit different, is we'll actually rotate on which underlying securities we are writing options against, depending on what presents the most value. We partner with Title with our ETF business, and they have vast experience with these types of options strategies inside of ETFs. They also work with us on our Theta ETF that utilizes the same type of strategy.
And talk a little bit more just about identifying those top 50 U.S. listed stocks that are held by the SoFi members. And it's interesting, as you were alluding to, SoFi already offered the SoFi Social 50 ETF, ticker SFYF, which, just like SFYI, that ETF owns the top 50 stocks held by SoFi investors. So it's essentially the same thing as SFYI, but without that options overlay. But talk a little bit about that process.
Yeah, and I think, before getting into that, this is probably one of the most pleasant surprises that I've had in my 8 years at SoFi. So I've been in the industry 20 years, and you think about it like, okay, passive investing, buy the index and just low cost, and I still believe in that. But when you look at what our members are actually investing in, I think it really speaks to the fact that we offer a robust suite of educational opportunities, digital tools, access to financial planners on a complimentary basis. And so then we look at these holdings, and you're going to see the big names that you would tend to think of. You got the Teslas, the Amazons, the Nvidias. And what I've noticed over the years is our investors are really focused on not only buying and holding high conviction ideas, they're not chasing past trends. We're not seeing, meme stocks and things like that in there. It is really diversified long-term investing. So we really just look at it every single month. We say, okay, let's look at all the holdings. What type of allocation is across our member base? It's aggregated. And that's what we use to select the top 50. And that's also what we use to determine the weighting on that. So the highest conviction among our member base gets the highest weighting, and then so forth down the list. I mean, you'll see right now in the latest update, Tesla is our highest holding, followed by Amazon and Nvidia. I don't think those names are all that surprising, other than, quite frankly, the conviction our members have in Tesla is overweight. But that's really how we determine these names, is by analyzing that and then seeing how that performs over time.
To your point, if we look at the top holdings right now, you mentioned Tesla, Amazon, Nvidia. I see Palantir. You were just speaking more broadly, but if we got a little more granular, how would you summarize where SoFi investors are placing their money right now? Because this will get us down the path towards some of the other trends that you're seeing across the SoFi platform. But what stands out to you as you look through those 50 holdings, and especially at the top of the list there?
Yeah, I think a few things stand out to me. Number one would be related to AI. And I think this is an area where, there's so many different ways that you can invest in AI. Do you invest in the underlying infrastructure? Do you invest in the adopters? Those types of things. And what we see as our members are really investing in AI from an end-to-end perspective, really focusing on the infrastructure. So we're seeing heavy traction in names like NVIDIA, AMD, and then on the platform side of things with Palantir, and then, Amazon from a cloud perspective. And I think if you look at it, probably about a quarter of our holdings in SFYF are related to the AI kind of super cycle as we kind of look at it. And I think that's pretty notable, because our members have high conviction in that. And they've been focused on that. I think the other thing that's notable, I hit on Tesla briefly, but our members have an outsized conviction, and it's growing in Tesla. So if you look at just kind of weighting to the S&P, it's right around 5 times the S&P weighting to Tesla. And they've continued to add to that during volatile periods of time. It's not like one of those things where, okay, a stock goes down, they just panic, throw everything to the wind, and they move on. They tend to have an underlying investment thesis and saying, okay, here's what we believe in, both short, intermediate, and long term. They stick to that thesis. And a lot of times in down markets, if they have high conviction ideas, we see them actually adding to that position, which it's a great example to me. And I love seeing that as a financial planner. That's my background. And those would be the two big things, would be the AI infrastructure focus, and then the conviction in Tesla, which is something that's really been dominating SFYF over the course of the last 3 to 6 months.
I think those are two great themes. And, clearly there's a lot of interest around both of those right now. But I'm curious, do you ever see instances where a stock will just come out of nowhere and jump up towards the top of the SoFi Social 50 list, and you and your team are sitting there scratching your heads, wondering what's going on? Or can you typically follow the logic when you see these names enter?
Yeah, I would expect that come the next rebalance, there will be a new name that gets added to the list, but it doesn't come out of nowhere. I mean, I think if you think about the big names that are coming, like it is a heavy interest name that recently became public. So I think like things like that, there will be interest in that, and there's a logical reason. I think another example, I think Rocket Lab was one of the names that really kind of popped up where it wasn't inside that top 50. It really wasn't even kind of in the next 50. And then there was, became higher conviction in Rocket Lab. But I think that really kind of shows that a lot of times what we see with our investors is we'll have the core names that we tend to see a lot of long-term conviction in. And then we'll see a rotation of a handful of names where it's really them looking for the next cycle rather than kind of chasing the previous cycle. Which is always interesting to see. And then we could see this not only in our members' individual equity trades, we see trends like this presented when they're trading ETFs, in conversations with our financial planners, what they're asking our digital tools about. So it really is a cool way to start to really understand what this type of investor is focused on and what they're thinking through.
Well, I love this. I just think it's such a fascinating window into what investors are doing. And some people want to see this data readily available to where you can see how investors are positioned across any brokerage or platform. You have that. You just have to look through to the SoFi Social 50 list, and you can see exactly what members are doing. And again, I just think offers a fascinating window into investor sentiment. Any other big trends you're seeing right now across the SoFi platform, whether we're talking ETFs, individual stocks, or even just broader market trends?
Yeah, I think, it's really interesting to me on the ETF space, especially what our members are doing. And I think it speaks more broadly to how the ETF industry has evolved to essentially, like everyone talks about, hey, ETFs have grown so much and all this type of thing. I think it's just a great example of ETF issuers finding product market fit and expanding the use cases of the products that they're offering. So we generally will see our members look to focus on ETFs in kind of like a portfolio construction method of core and satellite. So we'll see the core component where a mixture of active and passive ETFs during more volatile periods. We do see people shift more to actively managed ETFs as opposed to passive. And then on the satellite exposure side of things, that's where we're really seeing investors express their investment theses in a way where they're looking at thematic ETFs. So like we offer AGIQ, there's other AI ETFs and things like that, where that's where we'll start to see that rotation across different sectors and different themes. And then the last piece that I think is really interesting is during volatile periods of time, we will actually see our investors using ETFs from a trading perspective, where if we're going through a really volatile, let's say a down market, for example, we'll actually see investors start to introduce inverse ETFs to their portfolio as a way to kind of hedge, where they don't really touch the core aspect of their portfolio. They're essentially just using the inverse ETFs as a way to kind of buffer the down markets. And then the same thing when we're going through, a great bull run, we'll see investors introduce levered ETFs with really like that satellite component that they tend to use for trading. But it doesn't really touch the core, which is, again, I love it as a financial planner. I'm like, man, it's almost like they're doing what I would want them to do. It's a great feeling to see. But it's interesting how they could use ETFs to solve all of those different needs, whether it's the core component, the satellite component with thematics, or even the trading component where they could take levered or inverse positions to either amplify the risk or buffer the risk a little bit in their core portfolio.
Is the full complement of ETFs available on the SoFi platform, or are there any restrictions for certain types of ETFs? I know some brokerages, maybe they prevent leverage products from being accessible or easily accessible, or crypto ETFs. Are there any restrictions on the SoFi platform?
No, if they're listed on exchange, they're going to be available to trade. And I think that's one of the things where it's great to offer selection. I think it gives people choice to make the decisions that are going to be best for them. But it's even better to offer selection along with education. And then, like, a quick plug, I'm biased towards SoFi. I love SoFi. I've been here 8 years. But I think one thing we do really good is we integrate insights and education into our entire experience, because just saying, hey, you can't invest in this, you can't invest in that, you're not ready to handle that. I don't think that's our position to say that. Instead, it's okay, how do we teach you how to make these decisions, whether it be paying down debt, managing your credit, building a diversified portfolio, whatever it may be. Let's give people all of these opportunities to get their money right, or they could talk to a financial planner and then empower them to make those decisions with those products in a convenient manner.
I absolutely love that answer. I think ultimately the responsibility resides on the end investor to make their decisions. However, the industry, whether we're talking about ETF issuers or platform providers such as SoFi, I do think there is a responsibility to provide that education. And I love how you stated that there, that clearly education is central to what you're doing. And educated investors are always going to be better investors. So like you said, it's not necessarily your job to limit selection to investments, but to help on the education side.
Bringing this back to SFYF, if you look at the performance of SFYF, which invests based on our members' conviction over 1, 3, 5 year period of time, going back to, I think, 2020 when we introduced it, it's actually outperformed the Nasdaq index. So it's like, okay, our investors, and I've seen other indices out there and other social sentiment kind of trackers out there where they actually trail into broad indices. Our members have made those educated and informed decisions, and performance is not always king. I'm not saying every individual investor is going to beat the market, but the collective conviction of our community base has done a very, very good job doing that. And that's through the combination of both products and education that really kind of make the perfect synergy.
Let's talk more about SoFi's ETF business overall, because I mentioned at the top that SoFi does now offer 5 ETFs altogether. And it's interesting because you've been involved in the ETF space for over 7 years now, which I think might surprise some people. However, you only have 5 products. And so you've clearly been conservative when it comes to new launches. And so I'm curious how SoFi is approaching the ETF market overall, because you do have this brokerage platform. You have millions of investors or members. So what's been the ETF strategy here?
Yeah, I think our ETF strategy really mirrors our overall strategy as a business, where we're looking at it and saying, okay, here's what our members are doing. Where's the gap and where's the problem that we can solve in our members' lives, whether it be through enhancements on our brokerage platform, our loan platform, or ETF business. So we got started in the ETF space by looking at just passive, low-cost ETFs. We launched, SFYI is, the 500 largest US companies. It has an underlying bias and different methodology in the weighting compared to, let's say, just the S&P towards growth. Low-cost, broad, passive ETF, because that was a core need of helping our members really get started investing and getting broad exposure. And then what we tend to do is we're going to look at the data of our member base and find out what they're interested in. We get to see what they're trading in on the individual equity side of things, the ETF side of things. And if there is an opportunity for us to solve one of their problems better, then we're going to vet that solution and say, okay, if we launch this and we could solve the needs of our members, then ultimately we can solve other investors' needs as well. But that really is first and foremost, rather than saying, okay, we're going to launch 20, 30, 40, 50 funds in a year. We'll see 1 or 2 of them that kind of stick. We don't know if they're going to solve our members' needs. It's always kind of starting with that member focus first, because really the ETF business is just a part of our bigger ecosystem of everything working together. So we want everything to complement each other. So yes, to your point, we don't launch ETFs as fast as some of the big providers. We really want to make sure that we are solving a need and we have conviction in it. So we have 5 ETFs now after SFYI launched. We have SFYI, which I hit on, which is the broad large cap exposure with a growth bias. We have our Theta ETF, which is really our income focused ETF using treasuries as collateral, and it's focused on yield. And that we've been extremely happy with that. We have our SFYF ETF, which is our member conviction, but just straight on the equity side of things. Now SFY adds the income layer. And then we have AGIQ, where we saw an increased interest, as was reflected in our members' holdings, of AI. And AI was, like I said, AI can be so many different things to so many people. We saw an opportunity when it comes to investing in AI by focusing on agentic AI, not just, okay, who's providing and enabling artificial intelligence, but what companies are actually adopting it to improve their businesses, because that's a unique layer to this where I think our investors believe that can be powerful, and saying, okay, similar to the other technological innovations, it wasn't just the people that provide or the companies that provided it. It was the companies that took advantage of it that were really kind of the next wave of success. So that really is like the thought process behind us looking at ETFs, is identifying a need in our members' lives. How do we solve it? And if we solve that well, then it has more broad appeal to other investors.
No, I like the way you describe that. And so, just to be clear with the strategy, it does sound like you're looking at what are the needs of the SoFi members or users. What do they want to see? And if we look at a product like you launched last week, it was to meet those needs. And ultimately, if you're solving those needs really well, theoretically, then that would help with wider adoption of the product, right? If you're solving one investor's needs, you're probably solving another investor's needs as well. Is that a fair characterization?
Exactly. And I think the launch of SFYI, another thing that we looked at there was individuals leveraging covered calls. I mean, if you look at just in general, we get so many questions on covered calls. You see it on social media, you see it on different forums on how to execute covered calls. And I love covered calls personally. The downside is, though, it requires a lot of capital, where you have to own 100 shares of the underlying security. So you can have conviction in this idea, you want to generate income on it, but you have this huge barrier to entry. So that's another thing we would look at too, is that led to SFYI, was not only on the equity positions, but what are people doing in our options products as well, because we offer options trading. So it kind of feeds into that, where we get the ability to see that underlying data, and it allows us to figure out how to solve those problems. And hopefully we find product market fit with the ETFs that are trying to solve those problems.
Yeah. So in terms of SoFi's ETF plans moving forward, obviously you're going to look at what the needs are among your members, but can we expect additional launches? How are you thinking about this moving forward?
Yeah, so I mean, there will be additional launches as we identify gaps. I mean, we've had a couple filings with the SEC for additional ETFs that are public, and filing and getting approved to launch an ETF is ultimately different than actually launching the ETF. So we're going to continue to evaluate that. I think some of the ETFs where we actually filed for were again connected to the AI space to see different ways to invest in the AI super cycle. And I think what we're going to do as we look through this process is identifying, like, okay, is this really going to be differentiated to solve a different need than already being solved with existing ETFs for our member base? So we're going to continue to launch products, probably launch more frequently than we have in the past. But really, we're going to only launch a product when we're like, okay, this solves a unique need for our member base. We can easily communicate and tell that story to our member to get them to understand what problem this solves and how it solves it. And then we'll launch products once we're confident in that.
Just a few minutes left here, and this is a little off topic, though. You were just mentioning that there are some filings with the SEC. I'm sure you saw that the SEC is now seeking public comment on novel ETFs. So basically, they want feedback on how innovative ETFs come to market and how the SEC can best balance everybody's interests, right? Investors, issuers, and I would say the SEC itself. Any thoughts on that as someone who may be pursuing additional launches?
Yeah, I mean, I think overall, I'm a big fan of the idea that transparency is needed to help investors understand what they're looking at. I think that this probably goes back to my history as a financial planner. I mean, I've been working one-on-one with people for 20 years, and now I don't get to work one-on-one as often as I'd like to because I miss those conversations. But a lot of that is just connecting the fact that overall financial literacy is very low in this country. And that is a problem. And if people don't understand what they're investing in, why they're investing in it, especially during periods of high volatility, then it can lead to suboptimal decisions. So overall, I think ensuring that retail investors can understand things better and have more transparency, especially in volatile periods of time with more novel and more volatile investment vehicles. I think that's extremely important because it just builds confidence in the industry. And I just continue to hope that the industry and I guess providers like us continue to evolve their education to be more user-friendly in general, regardless of what the SEC says. Like, let's make this as understandable as possible, because we've seen firsthand at SoFi, like, if you help people understand their finances, you help them understand what to do next, they will make good, responsible decisions, and it's going to help them. And then you're helped as a company because they stick with you and they do more business with you.
Extremely well said. It always comes back to education, improving financial literacy. You mentioned transparency, a number of my favorite themes. But Brian, really enjoyed the conversation this week. Best of luck to you and the SoFi team moving forward. Congrats on the launch of SFYI. Thank you for joining me.
Yeah, thank you so much for having me.
That was Brian Walsh, Head of Advice and Planning at SoFi. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Dave Nottig, President and Director of Research at ETF.com. So we'll go all around the world of ETFs, and we'll see where that takes us. And then I'll also be joined by Paul Bayaki, Head of Fund Sales and Strategy at SS&C Alps Advisors. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.